Hey, what's up everyone? As you know, I consider myself to be a value investor. But what does that really mean? A lot of people convolute value investing with value stocks, the opposite of a growth stock. It's really not that at all, and I want to talk about the difference in this video. Next, I want to talk about what skills you need to be successful as a value investor. Let's get started. So when I say that I'm a value investor, I don't mean that I only invest in quote-unquote value stocks. We all know what a value stock is. We've all seen value stocks. We're talking about stocks that aren't growing much, companies that pay good dividends, maybe a company like AT&T, Walmart, Pepsi, something like that. While I do refer to those companies as being value stocks, that's not what value investing is. Value investors invest in both value stocks and growth stocks. The important thing is, and this is really key guys, to be a value investor means that you're trying to buy stocks for less than their intrinsic value. I mean, that's it. That's really it. It really sounds simple. It is simple. But, of course, figuring out the intrinsic value of a company is really not that simple, as you've seen from my videos. So that part is hard. But the concept is extremely simple. So when you do value investing, you are making a few key assumptions, and I want to talk about those real quick. The first assumption you're making is that you can figure out the intrinsic value of the company. Specifically, you are assuming you can use the information in this company's financial statements to approximate their intrinsic value. There's kind of a big assumption underlying this assumption, and that is market efficiency. Now, market efficiency is a deeper topic. Maybe I'll make a video on that at some point. But to be brief with it, market efficiency simply means that the stock price at any given point in time reflects all public information about the company. So when you do value investing, you're actually assuming the market is not so efficient. If it were very efficient, what would be the point of studying financial statements? The price at any given time should reflect all the information in there already. So for those among us that believe the market is actually very efficient, these kinds of people generally invest their money in index funds. So to be a value investor, you're definitely assuming the market is not that efficient. The second major assumption of being a value investor is that stock prices will approach their intrinsic value over time. There's no real rule for what period of time that is. It's just that in general, prices will approach value. Now, what's interesting is that this second assumption isn't even really necessary if you're buying a dividend-paying stock. If, according to your analysis, the present value of the stream of dividends coming to you is greater than the stock price right now, well, you just buy it and you don't even have to worry about the price at that point going forward. If no one ever buys a stock from that point on, you don't care. You've done the calculations and you're going to have a gain. But for many of the stocks you analyze, especially growth stocks, they won't pay dividends anytime soon. So you are kind of relying on the market to get it right at some point. Luckily, that usually happens. If you're enjoying the content so far, please don't hesitate to hit that subscribe button so you can check out more of my videos. Okay guys, now I want to talk about the skills that are necessary to succeed as a value investor. Number one is going to be patience. There's really no rule that says that right after you buy an undervalued stock, it has to then approach its fair value. No one cares that you buy the stock. It could go down further. It could go sideways for years before it approaches the real fair value. So you got to have patience. Just remember, investing is really like playing baseball with no strikes. You can just sit there and watch the pitches come by and wait for the perfect pitch and swing at it. The number two key skill you're going to need as a value investor is confidence. If you decide a stock is a great deal and you buy some, and the price then goes down by 20% and you can't really figure out why, it's an even better deal. You should buy more. But that's easier said than done. Because no one really knows all information about a company, when we see the price go down, we start to worry that our calculations are off. We start to worry that we were wrong all along. You got to be confident if you want to maximize your profits as a value investor. I mean, we all know how to make money. You buy low, you sell high, but it's always a lot harder than it sounds. So you got to have confidence, And the number one way to get confidence is to do more and more analyses, do them thoroughly, so that over time you become confident in your numbers. If you haven't done any analyses, if you just look at a stock and say, gee, that's a nice PE ratio, I think I'll buy it, you're not going to have as much confidence. If you really do your homework, that's going to give you the confidence you need to do the right thing. Now, to the naysayers of value investing, here are some common complaints I hear, and here are my responses to them. Number one complaint is that, hey, the PE ratio is dead, the market to book ratio is dead, that sort of stuff doesn't matter anymore, just look at Tesla. Well, for that, I would say that's got to be one of the most ridiculous things I've ever heard. You're telling me that you really don't care about how much money a company makes when you go out and buy a company? Okay, I have a bridge to sell you. Yes, Tesla has gone up dramatically in price, but that doesn't mean the price is right. Again, remember, the market is not that efficient. Market efficiency really can be dispelled when you look at this chart here. At the beginning of 2020, Tesla was trading at a split adjusted amount of about $88. Today it's closer to $800. So is the market efficient today, or was the market efficient at the beginning of the year in 2020 there? Which one is it? It can't be both. It can't be simultaneously that Tesla was worth this much on this day and now it's worth 10 times more. I find that to be really unlikely. The other complaint I hear a lot is that discounted cash flow techniques have way too many assumptions. To that, I would say we're making our assumptions explicit. Whereas when you compare two companies and you look at their price to sales ratios, or you compare their PE ratios or whatever, your assumptions are rather implicit. You're not really being direct with them. You're not laying them out, but they're there. They're really embedded in the whole process. Okay, finally, I want to circle back to this idea that markets are efficient, prices always reflect all public information, so therefore there's really no value you can gain from doing fundamental analysis. There's no way you can earn higher returns by analyzing financial statements. The idea behind this is called the efficient market hypothesis, but it's really impossible theoretically if you think about it. If markets were so efficient that stock prices almost instantaneously reflected all the public information available, if that were true, more and more investors would lose the incentive to analyze companies. There would be no point. There's no value to be gained. So as fewer and fewer people actually analyze those companies, the stock prices would start to not reflect all the public information. So then there's an incentive for people to analyze the companies again. So to me, it's kind of a circular argument. There are a lot more people believing in efficient markets these days. That's why you see the big rise in passive investing. A lot of people own index funds. But I definitely believe there's value to be gained from fundamental analysis and value investing. Alright guys, so that's my take on value investing. I really hope you enjoyed the video. If you did, please give me that thumbs up, that like button. It really helps the channel. Thanks for watching.